Welcome back, friends. All that is gold does not glitter. Not all those who wander are lost. Today we're talking about gold. Let's get into it. So, gold in 2024 has had a phenomenal year. It's up 30% so far. Last year was pretty good as well. I've been holding gold since the beginning of the year, and no, it's not because of any, foresight or any model. It's because it's part of the long-term portfolio. The long-term portfolio requires a constant gold exposure, regardless of, the economic environment or political environment, whatever the various reasons are people hold gold. It's good exposure to have in a long-term portfolio. It's something that approximates an all-weather portfolio, right? So I started that portfolio at the beginning of the year. Gold was supposed to be part of it. I put gold in, and gold is up 30%. That is wonderful. I can't take any credit, but I will take the profits, right? But for us now, we can talk about why gold is a good thing to hold in something that looks like a long-term portfolio, like an all-weather portfolio. But since I've expanded the functionality of the game engine and the backtesting engine, we can actually start talking about gold in terms of trading positions and trading models, right? And last week we had gold triggered both the models F7200 and T19800 as well. So I thought it would be a good time to talk about this. So one of the reasons you might want to hold gold for the long term, even when it has like these horrific years, like 2012, 13, like these bad years, is that on average, right? This data goes back to 2000. I was I couldn't get data that goes back farther. When I do, I'll update this video as well. But like 24 years worth of performance is good enough for our purposes, right? So over the last 24 years, gold is annualized at like 9.7%. It annualized at 10% with a vol of 17. And that's not a bad thing to add to your portfolio, right? And that's the reason I added it to my portfolio. It's relatively uncorrelated. It does its own thing, right? And it gives you an exposure that you can't get in in any other assets. I mean, I guess you could uh, make the make the argument that Bitcoin is sort of doing that. Bitcoin is the digital gold. I'm not so sure about that because Bitcoin also, it behaves like 3x levered Nasdaq position. So maybe, Bitcoin is the new gold, but gold has been gold for the last 5,000 years, and it has managed to hold its value over those 5,000 years relatively well. And so put it in your long-term portfolio, and you don't have to really worry. It's fine. Uh, but this is in the long-term portfolio. We're going to be talking about it in terms of trading positions. And last week, like, oh my God, there was so much chatter about gold. And so I saved some of those tweets, right? So you had Zero Hedge. I think these guys are gold bugs. I don't really follow Zero Hedge all that much, but whenever an interesting post comes up, I save it, right? So gold, another day, another record high, 6 day in a row, on pace for the best performance this century. And yeah, it is the best performance. Like the gold bugs, the gold bulls, they deserve this, right? Whether or not their reasoning for why they need to hold gold is right or wrong, at the end of the day, it's the price that matters. It has gone up. It had an average year for gold is 10%. This year it did 30%, and that is wonderful, right? And so if you got 30%, good for you. Wonderful, right? You have Jesse Colombo as well, talking about secret buyers, and I think he's linking to a Zero Hedge article. I didn't read the article, but I'm showing these tweets just to show the sentiment, that we're seeing, especially amongst people who are who are long gold and who've been long gold for a while, right? You have Lawrence McDonald. He's written a really good book. I'm in the middle of reading his book. I'll link his book in the description. And I think in 2019 he made this post, historic move. I think gold was like at 1300 or whatever. Today it's at 26 and change. And Goldman Sachs forecast is 2,900 for quarter one and two next year, right? WinSmart is another really good account, always putting out really good material. Um, and it looks like, banks are saying that their forecast for gold is something like 3,000 for fundamental upside, 2,700 for technical upside, and $2,000 for a central bank floor. I don't know if there's a central bank floor, but I'll take their word for it. It's fine, right? But here's something else you need to sort of understand as well, right? So when times are good, the investment banks are gonna give you rosy forecasts, and when times are bad, they're gonna give you gloomy forecasts, right? So uh, this is not something to be relied on. If gold was down 30%, these forecasts would be like fundamental downside forecast, technical downside forecast. Like this is a measure of sentiment. It's not you should take it as not as an objective thing, more as a subjective thing, right? Gold prices are high, so now they're saying it's going to be even higher. And yeah, so gold is good, but for us, F7200 and T19800 both triggered overbought signals essentially. And now you might say, oh, okay, so is gold overbought? What exactly does that mean? Right? Does it mean that we're going to be a crash is coming? Well, maybe, but let's break down the data. That's what we do. We break down data before making all kinds of crazy fucking predictions. So for F7200, gold futures crossed the 90th percentile, and you can see those red dots. You've seen these charts before, right? And basically every single time F7200 has crossed the index value has crossed the 90th percentile, I've marked these out and I've added and you can see the chart as well, right? So sometimes, you might actually catch a top, right? Other times, on average, you're doing pretty well, right? So on average, you're looking at 1 year out, you're looking at 11%, let's say 12% as your median return, your expected return. Your best case is something like a 40%, like 38, like 37.5. Let's just call it a 40%. Your worst case is more like a minus 4.5%, which is actually pretty interesting. Like if you look at this column here, basically what this is saying is that the risk that you're sort of looking at is concentrated in the first 3 months, right? You're looking at, let's say, minus 15, minus 20% in the first 3 months. But if you extend your trading horizon, your worst case sort of becomes better and better. And we can see that in this chart as well, the cumulative return paths. And this is every single time the index has crossed uh, the 90th percentile. Now, the thing is, if some of you listening are like mean reversion traders, and you'd be like, well, gold market is overbought. It's overbought. It's past the 90th percentile. RSI is greater than 70. RSI is greater than 80. Oh, we've got to be short. No, no. See, I used to make this mistake as well, but the thing is, you should let the back test tell you what direction you need to trade, right? Because sometimes what ends up happening is you'll have markets where um, the market becomes overbought and then it will do a 30%, then it will do a 60%, or a market will become oversold and then it will do a minus 50%, right? So just because something is overbought or oversold doesn't mean the upcoming move is um, you have to short the upcoming move. That's at least that's not the way I think about it because I'd rather let the market tell me, like whatever market I'm looking at, I'd rather let it tell me what it's actually done historically because that's all we really know, right? The most we can say here, even for F7200, right? It crossed the 90th percentile, right? It did it. What exactly did that mean? Intuitively, you might say, well, it crossed the 90th percentile, so I need to go short. But your intuition when it comes to financial markets or complex systems can be very, very wrong, right? Like our brains aren't meant to understand these things, right? That's why we need to break down data. That's why we need to do the analysis, right? So intuitively, you might say, oh, well, no, I got to go short. No, right? What it's saying is that more on average, even if you cross the 90th percentile and now you're technically overbought, you still, for at least 1 year out, you still have a positive return in front of you, right? And that's fine. So this is what F7200 is saying, right? By the end of the year, there's a 90% chance that you're gonna have a profitable trade, and here's your 11.6%. And here you can actually see that for the first 3 months, 3 or 4 months, you're basically looking at chop, right? That's where your risk is. So for the next 2 or 3 months, we should be expecting for F7200, we should be expecting uh, gold to just take a breather, right? And this is what F7200 is saying. Let's see what what T19 800 is saying, right? So here's an interesting thing. The reason I brought up both of these models together is because they both triggered at the same time, right? And that's generally interesting, right? When you have two models sort of saying the same thing, because when that happens, that's when you have to start paying attention. Because think about it in terms of, let's say you have a team of analysts, right? You have a guy that does fundamental analysis, you have a guy that does technical analysis, you have a guy that does global macro, you have a guy that does quantitative analysis, you might even have a guy that does astrology. Apparently, financial astrology is a real thing. There are people who um, who base their trades on astrology, and even that's a thing in the financial world. But let's say you have a fundamental analyst, a quant, a technical analyst, and a global macro guy, and you sit them down and you ask them, all right, what do you expect gold is going to do for the next year? You might end up getting four very different looking answers, right? Because generally the worldview you use, the mental model you're using, doesn't necessarily mean your interpretation, your prediction will be the same across all these different mental models. Like the technical analyst might be looking at charts and say, well, gold, it looks overbought. It needs to take a breather. It XYZ. The fundamental analyst might say, well, gold stocks, you know, supply demand is looking good XYZ, and their debt fundamentals are they're like these gold stocks don't have liquidity problems, and then they'll come to a conclusion. The global macro guy might say something like, oh, well, unfunded liabilities are like at 200 trillion, and debt to GDP is XYZ, and money printing is going on. Gold is can only go up now, right? And that will be his view. And the quantitative analyst might, pull out some crazy machine learning model and be like, based on this, based on this model, I think gold is going to do this. So you might get four very different answers. And but sometimes, right? Sometimes what ends up happening is that all four of your analysts will say the same thing. The technical analyst, the quantitative analyst, the global macro guy will say, well, gold is going to go up, right? And when that happens, right, your conviction levels should start to rise very quickly, because when all of these guys are saying four different things, you have a lot of uncertainty as a portfolio manager, because now you have to decide which guy's opinion are you going to rely on, all right? Because imagine, like, these guys are all Ivy League school trained, they're all geniuses, but they have four very different answers. So now it's up to you to decide, oh, well, okay, why should I ignore the technical guy and give and bias towards the global macro guy? Now you have to add something else that comes from you, right? But there are times when all four of these guys agree, and that's when your conviction should go up. When you have different uh, kinds of analysis, sort of adding up to the same conclusion, that's when you should. All right, this is a good time, right? And so F7200 and T19800 are two very different models, right? The way they process data, the way their view of the markets are two very, very different models, like let's say mental models. And they're both saying that gold has crossed, the 90th percentile, and for T19 800, it's crossed the 99th percentile, right? So when stuff like this happens, I tend to pay attention. All right, so let's take a look at T19 800. So the index here, it's crossed the 99th percentile, and that's great. But here you can see something interesting happening. The last two times this has happened, right? It was basically a top signal, right? And now it's the third time. And by the way, if I'm using very specific language, I'm using the same language that the rate cut guys use, right? The last two times this rate cut happened, the third time the market crashed by 50%. So if you're bearish on gold, here's your signal. File it with the rate cut signal and see what happens. But once again, we want to look at all the data that's available. We have data that goes back to 2000, right? So on average, right, even with the T19 800 signal, your median return, your median expected return is a 10.4 for F7200. It was 11.6, right? Your best case is like a 20%, and your worst case is like a minus 12%. The interesting thing about T19 800, what it's saying here is it's basically saying that your risk is sort of sitting like around a 20%, 10 to 20% for your entire horizon, right? So you have two models saying that your risk, for one model saying that your risk is sort of like a minus 20% for the entire year. F7200 is saying your risk is more like a 15 to 20% for the first 3 months, but then it gets better, right? And we need to be able to deal with this, right? And I'm going to show you how I deal with it. Well, let's go over this, right? So this is every single time it's happened, and you can see the spread is quite wide, right? A forward returns 1 year out. But here, for F7200, you had a 90% probability that 1 year from now your trade is going to be positive if you're long gold, right? You're going to make money. And for T19 800, it's 71%. Let's say 70%, right? So you're getting slightly different numbers, and we sort of have to account for these, right? And but your median return is quite consistent. They're both consistent with each other. Here, you're saying that your median return is sort of going to be flat for the first 3 months, just like an F7200, and then it's going to rise out to 10%. For F7200, it's 11%. And so if you were to ask me, now that gold is up, 30%, um, what do you expect for the next year? Like if we had to trade this position, right? And for us, um, our price target for gold for next year, a year from now, our median price target is 29.96. Let's say 3,000. Worst case is going to be 25.64. Best case is like a 36.91, which is like a 3,700. That would be a phenomenal year. But the thing is, if gold actually rises to 3,700, I would be quite concerned what the rest of the economy is doing. Right? That's a can of worms for another day. Um, and for T19 800, our median target is 29.64. Well, let's say 3,000. Same thing as F7200. Our worst case is 23.54. Our best case is 32.43. And so now I just like one table, right? Instead of giving two different forecasts, I'm just going to average. I'm just going to average these, right? Pick the simple solution. Pick the dumb solution, right? So if our median expectation is 29.80, let's say 3,000, right? By the end of the year, at the end of this year, 1 year from now. Worst case is 24.50, 24.60. And best case is 34.65, 67. Let's call it a 3,400 or 3,500, right? And that's what we think gold is going to be doing for the upcoming year. Now, if you're a gold bug, right, if you're bullish on gold and you think that we're going to end up somewhere like in these extreme positions, right, like these 1 percentile pads, where you're looking at a plus 30% even from today and or plus 40%, let me know why, right? And if you think that gold is sort of like this is a top, let me know why as well. It's always interesting to hear, but in terms of just base case expectations, we're expecting something like 11%, and that's good enough. Um, I think the next thing we should talk about is uh, treasury rates, but let's see. I haven't decided what we're going to be talking about next. I've built up quite a large position for Canadian stocks. I eventually have to get to it. That's going to be coming up soon. But that's our talk for gold. If you're long gold and you reap this 30%, congratulations. And if you're thinking about going long gold, because gold is up 30%, what we've talked about is what you should be sort of expecting. And if you think, this is a top for gold, um, let me know why. It's always interesting to hear other people's explanations and theories. Thank you very much, friends. Talk to you guys very soon. Have a good day.